following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as from this here Options Insider Radio Network. And if I sound a wee bit under the weather, I think the many polar vortices have finally caught up to me. And so I still have my voice, which is a good thing. We'll see if it lasts throughout the entire show. Thankfully, I'm not alone on the old show. I don't have to do all the talking. I'm joined by my boon companions here on the old all-star panel, starting off with the man beaming in from scenic and lovely St. Charles. He's joining us at the top of the show today, so we have to welcome him as soon as he joins us. None other than Mr. Uncle Mike Tusaw from RCM Wealth Advisors / RCM Asset Management / RCM Everything Under the Sun. Mr. Tusaw, welcome back to the program, sir.
Well, always good to be here. With a welcome like that, I should start showing up on time more often.
And we can usually tell when there's another snowstorm brewing in the Chicago area because the Skype gods seem to take a frown upon the old St. Charles area. It seems to be happening today. So hopefully your connection will hold up and we'll get you on thick and lustrous as usual throughout the whole show.
Sounds good.
Speaking of thick and lustrous tones, we are also joined by the Viceroy, a.k.a. one Alex Jacobson, beaming in from Casa Jacobson, where the OX firewall cannot touch him. Mr. Alex, a.k.a. Mr. Viceroy, welcome back to the program, sir.
It's good to be here, Mark, watching all this after-hours activity, which I think we're going to be talking about in a little bit. But Google reporting today, Amazon reporting today, and Chipotle reporting today. That was the desk activity at OX today. Just consistent in those three names. But a good market day overall, and it is snowing like a bear out here in the burbs.
Yeah, apparently we haven't had enough snow yet this year because we're getting quite a bit more here. How are things cooking in your neck of the woods, Mr. Rock Lobster, a.k.a. Mr. Andrew Giovinazzi, beaming in from the warm and balmy state of Maine these days? How are things looking over there? You guys getting dumped on as well?
You know, warm and balmy for Maine is not normally associated together. However, we're just plain cold. It's ice skating weather. It's actually lovely, sunny, about 12 degrees, and looking forward to a weekend of ice skating and general fun and frivolity outside in the frozen Northwest. But we actually, coastal Maine, not much snow. Some more snow in the hinterlands and the mountains, but it's actually not too bad. It's only about 25 degrees right now.
Well, it's probably like 30 or 40 degrees warmer than it is right here, right now. Sounds like a good weekend for the old hot skates, and it sounds like a good time on this show to dive right on into the trading block.
The Trading Block.
Probably have to explain that again one of these days, Andrew. People probably listen and saying, what the hell is he talking about, hot skates? So those who aren't diehard Mainers or ice skaters are probably wondering, well, maybe we have a little time on a show one of these days. We'll dive into the origins of the hot skate phenomenon. But for now, we're going to dive into the market phenomenon today. Apparently, the correction is over. The panic is over. Everyone who was heading for the exits got back in today. Most of the major indices up dramatically. S&P up about 1.1%, or almost exactly 20 handles to 1794. Dow, a bit of a laggard today, only up 3/4 of a point or so, 3/4 of a percentage point, I should say, or about 110 handles to 15,848. The NASDAQ leading the charge to the upside, up about nearly 2%, 1.8%, or 71 handles to 4123. The VIX cash coming off ever so slightly, down about 1/10 of a point to 17.24. And as Alex alluded to, it is the heart of earnings season. We've had quite a few names announced already, and as he mentioned, we have quite a few coming out after the close. Maybe we'll dive into some of the names that have already announced and kind of give you our takes on them, and then while we're waiting for the rest of the names to announce today, of course, we have Chipotle, we have Google, and Amazon, 3 big names I know a lot of you guys out there like to trade. And in case you're still wondering, we're recording this on January 30th for all of you out there playing the home game. Uncle Mike, we'll start with you. I used to tease you mercilessly about that 460 put, saying, oh, why don't you roll it up? Why don't you get a more relevant put? Blah, 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 blah. It's starting to seem a little bit more relevant these days.
Well, yeah, we did roll it up a couple weeks ago, actually, but I deserve to be teased as always because you guys, I enjoy getting teased from you, especially when Apple's going up and I'm long it. But what we did a couple weeks ago, or going into the earnings, we were actually long the 535 put, and we were also long a 560-600, or short a 560-600 bull put spread. So we were just kind of doing a straddle, but we kept the upside as a hedge for going into the earnings, and we went out to April with it. But with that, after the earnings announcement, obviously Apple did not do as good as the bulls would have liked it to do, let's say. And where we're at right now with Apple, or we did this the day after the earnings, currently long the April 480, and for financing purposes, we are also short the weekly 480, 470 put spread, about the same ratio of contracts for next week. So for now, so far so good with it. And it seems like Apple's appearing to be somewhat stable around the 500 level. It seems every time it's gone below 500, it's come up, except right now it's at 499. But time will tell, and even if it goes down, we're ready for any action that needs to be done.
Obviously, it's still early in the earnings season, so we can't really construct the full narrative yet. But it seems like, at least so far, it's playing out kind of the polar opposite of last season, where we saw pretty much premium sellers were taking a lot of money out of their accounts and doing pretty well overall. And because names just weren't really moving, seeing kind of the flip into that script of late. Microsoft doing fairly well post earnings. We saw Facebook, a lot of names. Apple, most of them seem to be outperforming their straddle. Seemed like the lone exception, at least among the big names of late, was Ford, announced earlier this week the best year ever last year, and essentially closed unched the next day. So the premium sellers did all right out there. Unless you were scalping intraday, had a little bit of a range intraday, but nothing too crazy. But aside from that, at least so far, the narrative appears to be, for the most part, leaning in the direction of the premium buyers. Senior Giovinazzi, do you concur with that assessment, or you take the exact opposite approach just to be the devil's advocate? I know you are.
Well, I could be the devil's advocate, but I'm looking at Amazon down, $30 after hours. Google, I'm not sure. It looks like they came in line. But for a lot, yeah, there was, it's still a mixed bag. But some, actually several stocks have kind of been outperforming the earnings straddle. So maybe that 2.5 standard deviation, iron condor type play might work out. But you would need a lot more of them this time, because I think you'd have some issues in a few of them. So, but stocks are moving around, and I don't think this all this emerging market stuff, if we hit that kind of topic, is helping. It still seems to be pricing into the volatility and in the vol market, and I think in kind of like the flight to quality, treasury market in a big deal. It has not left I think in any meaningful way yet.
And what have your clients been up to so far going into earnings season? They've been trading a lot of upside in Facebook, slinging straddles. What's been going on over there at Option Pit HQ now that we're in the teeth of earnings season?
There's been a lot of earnings avoidance. There's been mostly trades put on after earnings.
Sounds like your clients. This just sounds like the kind of thing you would do.
Yeah, more like kind of butterflies after earnings, the vols coming in, stuff like that. Like some Christmas trees and things like that in Facebook today on kind of that after the big rally. Kind of hard for it to go up, 30% on earnings. But nothing huge, because mostly we've been like watching the vol market, and so that's been kind of taking everybody's eye right now. But nothing huge into the earnings season. But I think overall, earnings are okay. I don't know if they're enough to justify huger jumps in the market, but I don't think they're as bad as usual, as bad as everybody thought they would be.
I like to joke about trading into earnings and premium sellers versus premium buyers. Obviously, a lot of our listeners like to go that route, but we here on the show, if you've been listening to any particular length of time, know we're not exactly huge fans of that. Andrew is a devotee of free juice. Uncle Mike likes to avoid earnings whenever possible. He runs and hides in the corner. And then, of course, I've always taken kind of a similar approach to Andrew and kind of trying to take my gamma for free whenever possible, even though I mock him mercilessly for it here on the show. And Alex, he's never sold a straddle in his life. The man doesn't like to sell options. So in general, we're pretty much not a huge earnings trading crowd here, but a lot of you guys like to do it. And so we like to analyze it a little bit. And speaking of what we're talking about here, a lot of names after the bell. As Andrew mentioned, Amazon closing today, 402.65, trading right now in the after hours, down about almost exactly 30 handles to 473. Almost exactly in line with that straddle, too. The 402 half straddle going out about between $31, $32. So it looks like it's coming right in line with about that. We'll also flip over to one of my favorites. Haven't traded this one in a while, but used to be one of my favorites on my short list of names I would trade very actively. Excuse me. This is the Stealth Apple, aka Chipotle. If this things keep up, it might be a little bit higher price than Apple pretty soon. It's right about that same level again. Every once in a while, I should make an indicator, the Apple Chipotle indicator. Whenever those two are about equal, crazy things seem to happen in the marketplace. Of course, Chipotle closing today at $4.93, almost $4.94 here, and that $4.95 straddle going out at about $39. And we're seeing a pretty big move here in the after hours. Looks like about $53. It's up trading about $5.46 right now in the after hours. So pretty aggressive movements there. Let's see if Google, if they've come out and if they can maintain that narrative. They already had a bit of a run. Obviously, a lot of news coming out of Google. Pre-earnings, the licensing deal with the patents with Samsung, the sale of Motorola to Lenovo, a lot of things going on, moving that market, moving that underlying, going into earnings anyway. So you might have got some of that bump already. And of course, it closed today up 2.5% or $26.50, mostly off the strength of that Motorola sale, divesting themselves, what a lot of people saw as a wasting asset. And here we have Google closing today 11.33 half, and right now in the after hours, it doesn't seem like it's really come out yet. If it has, it's a pretty middling because it hasn't really moved a whole heck of a lot. So we'll give that a little time to percolate. That at the money 11.35 straddle going out today at about $63 or so. So we'll see if Google can maintain the narrative so far and keep things going on.
It's been schizophrenic in after hour. It was up 30 immediately after the earnings, traded on down 30, and now it's up 9. So totally schizophrenic.
Yeah, that's what I get for gassing on here in the trading block. I don't get to watch all the minutiae, right? It has been all over quite a bit already. So far, at least, yeah. Again, another argument. We won't get into it. Another argument for perhaps after-hours options trading. Close out some of those when it's trading unched in a few minutes. Might be kind of attractive to a few of our listeners out there. Alex, aside from the big earnings 3 today, anything else catch your eye in today's market or today's developments?
Nat gas. We've had a lot of activity in nat gas and nat gas options. And today it dipped a little bit because there was a report, get this, that said going forward it's going to be a milder winter that we won't continue with this polar vortex.
That's a brave prediction going into February. The winter's almost done.
Yeah, it's the old joke on Wall Street. What did we used to call economists weathermen? Because their forecasts were just as good. But a little bit of nat gas today. And other than that, it was just the big three. And watching this Google and After Hours, I'm flummoxed. I just don't understand. This thing has moved almost the $70 range in After Hours. Now it's up 11. And this is just that classic of don't rush to trade when you see the earnings number. Take a minute or two to digest it. But this is amazing. I mean, I'm looking at the After Hours chart, and it looks like the EKG of somebody they just brought back from the dead. The thing is swinging all over the place. It's funny. I don't understand it. I just don't get it.
You know, a lot of people think that, as soon as the numbers are announced, the street has this automatic and exact digestion process, and it immediately spits out the trading starts right at the appropriate price level where it should be, and it kind of vacillates around there a little bit. And nothing could be farther from the truth. If you spend any time watching any earnings in the after hours, you know that the street can be wildly incorrect. As I've joked many times in the past, when I used to scalp a lot of gamma and names like Intel and things, I had some of my best, most ridiculous, head-scratching gamma scalp, free money type fills around earnings time where people were filling me 7, 8, 9, 10 handles in the wrong direction from where the stock was moving, and just crazy things that you never would see any other time. But because the stock is so wild and no one really knows where it is because they're all digesting that information simultaneously. And what you're seeing right now in Google is a similar process, that feeling out process, everyone trying to figure out what exactly these numbers mean from a material perspective. And again, probably all this fluff, all this noise right now, one of the reasons a lot of people in the market, the option side particularly, are still a little reticent to list options and all this craziness. People are going to get wild fills and things like that. And that, of course, is the case. But I think at the end of the day, more liquidity is often, I err on the side of more liquidity, shall we say, rather than less. And right now we have zero liquidity from an options perspective. That's not exactly a good thing. Uncle Mike, aside from the Apple big announcements, anything else really catching your eye this week? Of course, a lot of announcements, some movement in commodity land as well, as Alex was just talking about. What else caught your eye out there aside from the big fruit company?
Let's looking at my favorites, the shiny gold. After the taper announcement, it looks like gold's having a little bit of a pullback today. That gave me an opportunity to sell some premium. I've been just long GLD for a while, so I sold a short put spread today. Just very choppy with where we are. Google is kind of like a micro of what Google's doing these last 10 minutes or whatever it's been. Seems to be like an example of what this whole market's been doing over the course of the past week. It's definitely been very choppy, and I've been doing a lot of adjustments on hedges and that type of thing. But for the most part, looking forward to it possibly evening out a little bit to give my kidneys a break.
Yeah, speaking of evening out, it is an interesting time. Of course, we had this seemed like panic sell-off over the last few sessions in the marketplace, market taking a hit of around 1% a day, it seems like, for most of the last few sessions. And if you put that all in perspective, looking back until today's rally anyway, that wasn't looking too good for January. We were down about 4%. You're a little bit more, a little bit less, depending on what index you were looking at, but roughly 4% for the month of January. Today is going to wipe out roughly 1% of that, so maybe we'll only be down 3% or so for the month. But still, so far, not exactly the most compelling start to the year, which is kind of funny. I think it hit a lot of people even more just because that narrative coming into the beginning of the year was, nothing but upside ahead, because, we know kind of have some insight into taper, kind of know what's going on across the board and a variety of other things. No big domestic political squabbles, at least for a few months, few quarters. So we had seemed like clear sailing ahead, and then all of a sudden the tax sell-offs, and then now this kind of Argentina/earnings/general fear/profit-taking sell-off. A lot of things starting to pile up and maybe changing that narrative a wee little bit. Andrew, anything else you want to add to that mix, or should we roll on into the odd block?
Oh, no, just like the tapers for real. They're going to start. They're getting out of buying these bonds. So, and I think that was it. While it's short term, it might make things choppy for the market. Overall, I think it's going to be better. The Fed's got to get out and let things handle. And there will be adjustments. So it could be a nice buying opportunity at some point during the year. If you feel like you missed last year somehow. But at least for right now, although some individual stocks, obviously like the Facebooks and even Google here, are doing okay. But that realistically, now that the reality of they are going to start pulling back, I think that, not every dip will be a buy, it feels like. So we'll see. But we might have to reevaluate our volatility targets this year.
Yeah, the single digits. Yeah, we're a little bit away from that, so we'll see if we start creeping back down here. Heresy,
I saw 8% volatility at the money the week of the Martin Luther King holiday, which, of course, we know we had a little bit of a move that week. But it was 8% at the money before that. So it did get there.
It danced there. It danced there. We never really said how long it would last. It flirted with it, and that's really all that matters at the end of the day, right? All right. And with that, we're going to keep on rolling right on into our next segment, the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, you know what that funky tune means. It is time once again for the Odd Block. My voice is holding up so far, cracking a little bit there, but I think I may try to save it a little bit and toss the hosting reins for the Odd Block at least over on to Mr. G, a.k.a. the Rock Lobster, a.k.a. Mr. Giovinazzi. So, Mr. Andrew, take it away, sir. Where would you like to start in today's Odd Block?
Let's start with, excuse me, the cereal company Kellogg. I think that is this is a trade. This is one of the trades where, I think theoretically it might look good, but I think it's bull. So stock was down a little bit today.
Is that your technical opinion? This is a bull's region. We should put that on the site. Bull trade in Kellogg. That'll get a few clicks, I think.
So, this is basically, and this is okay, emerging market sell-off, whatever, total thumbing their nose at everything. Gotta love it. Where paper is selling the Fed 55 puts in Kellogg, and earnings are coming out in a couple of days, like a week or so. So they're selling the Fed 55 puts for 15 cents, which going into earnings. Now this is Kellogg trading at the low end of the range, but I still find that like I said, bold. So it's relatively, for Kellogg, it's 20 volatility. It's high. Like I said, theoretically, it's a high volatility. Realistically, it's not a lot of money.
That is certainly bold. I thought you said bull at first, which I also could subscribe to for this trade as well.
Yes, it is bullish and bold. So,
or just straight out bull. One or the other.
Straight out something. But anyway, that's what we got here. So it's a 20 volatility sale, which I believe is probably about as high as the volatility gets in Kellogg ever. I'm just taking a look to confirm, but I'm pretty sure that's about the level. And I guess they want to own stock. That's all I can think of. They want to own stock at 55. Yeah, it's a 6-month high in volatility at 20%. But you're selling the puts for 15 cents. Yeah. And there's all lots of little trades. It was almost felt like it was a newsletter trade where the odds of this being successful are 9 to 1.
Yeah, this reeks of newsletter. Who else would sell a bunch of these puts for 15 cents? You're right. The vol levels are attractive from an underlying chart level. It's relatively attractive from a net premium to risk perspective. It isn't particularly attractive.
Right. Now, what I'm trying to think of, it's possible they might have pre-announced because Kellogg did a pretty, I would say, like a 2 standard deviation move down yesterday from about 60 to 58. So again, I can see why they're doing it. It's okay. It's a very high probability trade. But again, like I said, bold, B-O-L-D, bold, for the amount of dollars you get for it. Let's go to Rubbermaid. NWL is the symbol. It's trading up a little bit to 30.45 today. this was kind of the opposite trade where ADV is about 300 contracts a day. Open interest on the strike is 612 contracts. Basically, there was put buyers going in here. And the thing is, it was about mid-sized blocks, buying the puts up on the NWL Feb 30 strike, with the puts still bid by the end of the day. Again, not pushing the volatility up a tremendous amount, but almost like the opposite trade that we saw in Kellogg. They're actually buying puts, balls up tremendously, and the stock is looking like a lot of charts of most stocks lately, just kind of the vanilla S&P 500 stocks, down about 10% from their highs. And this looks like it's more of a hedging play to me.
Yeah, this kind of screams a big underlying holder here, just looking to put something on ahead of earnings.
Exactly, and that's kind of what that's what I thought. But it's pretty in the volume actually now toward the end of the day. 8,600 contracts, way over the open interest. So definitely looking like maybe some side of protection. The market's maybe getting people a little bit skittish as we go into the close, but looks like a protective trade to me. But that's, again, at the money volatility. And those puts are now trading around 95 cents. So whatever they did correctly, the 65-cent put buyers. What they know. Next is overstock.com.
This is a good one for a couple of reasons.
TK. Now, this was a range of prices for some puts. What started off was, I guess, after earnings, someone came in taking their open interest and basically dumping it on the Feb 22.5 puts. They traded for 50 cents. I think that was the first print. And then after that, the puts went straight up, essentially, trading as high as what looks like around $1.40 where they closed. So what happened was you have an early seller, and then paper came in buying puts literally right after that, clearly being right, and the stock was down basically $6 on the day, being pushed right to the strike. So I thought it was kind of an interesting a little piece of volume there. There was almost no open interest to start with, so the initial seller, excuse me, if they were they owned the puts, probably didn't make a whole lot on them at the beginning, and then they probably grew to a price that would have made some sense. But all the early put buyers looked like they were correct. And Overstock looked overstocked, down $6. Maybe foretelling what might have happened with Amazon to some degree.
One of the worst scenarios that used to get happen to you on the floor is you get in on those early levels, those early kinds, and then the broker comes back. How are they now? Clearly having gone in their favor and against you, and it's just painful. And this poor guy, he thought he was capturing what little bit of vol was left coming in on the open, and little did he know he was about to get run over pretty hard. That's not a good feeling to have when it's immediately in your face like that.
I think that's pretty much that's what happened. So
that's our day in oddness and oddities.
Yeah, there's some boldness in there. There's some oddness. There's just some unfortunateness. So that's why we call it the outlook.
All right, thank you for that, Mr. Andrew. Of course, if you want to read more about what we talked about here, more detail on those, or all the ones we didn't really have a chance to get to on the show, surf on over to theoptionsinsider.com. Click on the unusual activity call out there on the homepage. You can find all that and a heck of a lot more. But now it's time to keep on rolling right on into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, listeners, you know the drill by now. This is the portion of the show where I take a bit of a rest for my voice, and Mr. Viceroy takes the reins and takes us behind the scenes at the land known as OX. And because he's been bugging me so much lately, saying, Mark, I need more time. There's so much to get to. I'm pleased to announce an extended 20-minute edition of the Xpress Block today, where Alex will take us through all of his thoughts and feelings, childhood memories, all that fun stuff. So, Mr. Viceroy, take it away, sir.
20 minutes, huh? Well, I will start by saying we are drinking the good stuff at Casa Jacobson because we had a granddaughter on Tuesday. So
yes, I've neglected to say it at the top of the show, but congratulations, sir. That is indeed a very, very welcome development.
Yeah, little Lola, named after my mother, went home today. So if I really have 20 minutes for childhood memories, we'll start with that. But today was an event-driven day, and as we talked about a little bit earlier, it was all the earnings names. And you look at the clientele at Options Express, and certainly part of that clientele is driven by earnings events. And but there is no solid tone. I mean, we talked about some of them like to sell premium going into earnings. Some of them like to buy premium. Generally, the premium buyers at OX are not straddle buyers. They're more buying the little stuff, and often they're buying into the skew, which is probably not the ideal trade. But they're looking for the earnings surprises, and we'll be very interested to see how Google and Amazon open tomorrow. I am perplexed by what Google's doing in after hours. I mean, as I say, it's traded a $70 range, and now it's almost unched. And I think that's a testament to, if you are going to trade stock in after hours, be especially careful. Because, as I say, in this case, you could have bought it $30 higher. Fortunately, if you bought it $30 lower, you're looking good right now, and you can get out. For those of you who don't understand after-hours trading, the trading desk at OX is open 24 hours a day, and there are after-hours markets, and there are it's not fair to call them after-hours markets, but there are markets outside of regular equity hours in futures products. So be aware that the desk is there. You can trade electronically after hours. You're only going to be allowed to place limit orders. But trading today was driven by the big three, Google, Amazon, and Chipotle. A little bit of MasterCard and Visa, but that's an earnings play as well. And then on the future side, on Mike Zaremski's side, Nat Gas and the Nat Gas options were active today. And if you do want to play in Nat Gas, as we've talked about a lot on the show, the ETFs just aren't really a good way to play. They don't track well enough, but you can trade Nat Gas options, and they're everything you're familiar with in an option. You want to buy premium, it's limited risk. If you want to sell premium, yes, you get the premium, but you're subject to the risk of being short an option. They can be spread traded. They can be traded electronically. Good volume day today. That's one thing about this year with all the volatility. We're keeping some of the volume trend up that we saw going into the end of 2013. I saw a little bit of our year numbers, and we were up double digits in futures and futures options. And I think that's a trend everybody sees as more electronic availability, more spread trading is coming into futures options. And a good day overall in the market. We sold off a little bit near the end, but a brisk day of trading, and an interesting day overall.
Yes, and just giving another little mid-show checkup here on the big names reporting, and you're right, Google still almost exactly unched, which is odd in and of itself, and the other two seem to be kind of holding steady as well. Amazon off about the exact same amount it was before, about looks like close to 40 handles now, and then we see Chipotle up a fair bit as well. So most of them not having the same extreme volatility as Google, at least so far in the session. We'll keep an eye on those as we keep on rolling right on into our next segment, the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and welcome to the mail block. This is, of course, the portion of the show where you guys get your chance to join us here on the old all-star panel. I'm going to read off these questions, and I think I'm going to let my friends here dive in for a bit, and maybe I'll chime in at the end just to save what little vocal cords I have left. Let's say first question here comes in from user goes by the handle CDog, and he writes, what is a scenario where you would consider a ratio vertical spread? And he writes in parentheses 1/2, 1/3 going into earnings. Now, this is something we talked about on the show in the past. Obviously, then the risk of being net short units, which is exactly what you are in a spread like that. When you're 1-to-1, this regular spread, you're covered. You know exactly what your max profit, max loss can be going into it. When you're net short units, which means now you'll say you're 1/2, then you're short that extra contract once you blow past that strike on the upside, and now you have that net short position that could keep endlessly costing you money. So that's why we, in general, tend to be pretty hesitant about those. Mr. Andrew, I know you're not a huge fan of being net short units in general. Probably comes from your degenerate market maker days. I know I had some of those lessons beat into me as well. But tell us your take here on some scenarios where you would consider being net short units, if they exist.
Around earnings, tough. Like I said, I prefer those plays after earnings. Like I mentioned, like this morning in our little vol report, I looked at a Facebook Christmas tree, buy one and then sell 2 more calls and successive strikes for credit. Mostly when you're looking for volatility to come in, but you want to kind of move away from what I call kind of moving away from the at the money. It's also not a bad play as kind of a covered right. Maybe you own some stock and then you put on a Christmas tree for credit, trying to give yourself a little extra bang for the buck for no dollars. That's a potential. I do have clients that trade what we have them do is like kind of a ratioed butterfly, like a broken wing butterfly, where you'd buy 1 and sell 2 for a good credit. And then you would buy a contract farther up. And usually for earnings, you would do that like 2 standard deviations out of the money, a pretty good amount. That way, if you do get that big run up to the strike, the ratio spread will actually still perform for you, but you're protected.
No. None of this protective hedging, proper risk management stuff. Mr. C-Dog wants to be naked short. Take him naked short, sir. Take him net short units.
I think anytime naked short where you can handle the result of the short contract. So basically, what I tell anybody is, if you want to make it work, if you buy one and if you do a ratio put spread where you're selling 2 puts, you've got to want to own the stock at that level. Right. And obviously and I have a lot of clients that do that actually real successfully. Mostly we wait till the stock's already kind of crap out before you put that kind of a trade on. In a good company that's just cyclically in a bad place and you want to generate a lower buying, you want to generate some premium before you actually are able to acquire it. For a company for selling it on the upside, again, usually it works best when the vol's real high, the duration's real short, and the stock has just made a big move. So, it might be a stock that's just jumped, 15 or 20%. That initial volatility is real high, and you can put on like a ratio spread or a Christmas tree, still 10% out of the money, and pushing your loss maybe even 20% out. So you really force the stock to make another move in order for the trade to, for you to actually ever really lose anything. So what I prefer is those trades after a big move when there's still decent volatility I don't think they're really great trades to put on when things are kind of quiet. You're like, oh, nothing's going on, so I'm just going to put on this 1x2 and make some money real fast. And that's usually when things are real quiet, when you have emerging markets, and then you're stuck with a position you might not want to have.
Of course, we talked about it on the show many times in the past, how when things like call skews get bit out of control, that's when these things may look more attractive, but of course that's also when they could also go in your face that much more aggressively. When the zealots are out, things like Apple and Facebook and whatnot, it looks attractive. You can put on verticals and ratios for ridiculous credit sometimes. Sometimes you may have to resist that temptation, unless you're doing what Andrew says, which is, of course, having a little protective thing to the outside just in case the worst comes to pass. That should show you, listeners. I try to take him to the dark side, and even then, I give him hypotheticals. He still won't discuss net short units. It's just not in his nature. That's just the kind of guy.
I discuss it with. It's the conversation I have when a client first gets portfolio margin and they realize, wow, I can do all this stuff, and it doesn't cost anything. And that's when I scream and yell and go, whoa, 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 whoa. Margin has nothing to do with risk.
Indeed. Mr. Tusaw, I know you're not a fan of this strategy as well. So are there any moments where you will break ranks and decide to get net short some units?
Yes, I did think of one, kind of. And this is just to kind of add to what Andrew was saying. If you can handle the result of being naked, the short option, let's say that you want to sell a put to get into a stock. One thing that I would bless doing is, let's say XYZ stock is at 40 and you'd be willing to buy it at 35. If you can buy the 40 put and sell 2 35 puts at net even money or possibly even a net credit, and you're willing to own the stock in the 30 area, then I would consider doing a trade like that. But other than that, I'll quote what I just wrote in the IM. The only time I would do it is if maybe you're mad at your client and you want to lose them some money.
Yeah, and of course the put ratio vertical being a little bit more attractive because you don't have that infinite loss components like you have potentially on the call side. It seems like for whatever reason when people write in about ratios, they're always talking upside call ratios. Yet put ratios equally valid and sometimes a little bit more useful. Mr. Viceroy, take us home. What's your take on these ratios and just in general being net short units going into things like earnings?
Andrew and Mike are spot on. It is the writer's God-given right to do it. He just needs to be well capitalized. And this is also a case when you try to put these trades up, especially net naked, you're going to, in this environment, need some resistance from your brokerage house. And Andrew talked about portfolio margining and how it gives you the ability to get a lot more leverage. You want to be cautious about these kind of trades because if you put one on and the vol of your underlying stock changes or your concentration in the stock changes, the portfolio margin rates are going to go up. And all of a sudden you found yourself in a position where you have to liquidate. So just as a general, if you're going to be a general thought, if you're going to have net naked short positions, don't take yourself to zero SMA. Be well capitalized. And we talk a lot about probability, 1 standard deviation, 2 standard deviation. The events in the markets have taught us repeatedly that sometimes our best estimates of risk, October 19th was a 12 or 15 standard deviation move. No, it wasn't. You don't get a 12 or 15 standard deviation move. It tells you that oftentimes our risk measures are wrong and we've misunderstood the potential risk. Our benchmarks are wrong. So if you're net naked short, you best have a lot of money and you best have a lot of money available. You can adjust your way out of anything. It's the martingale example in gambling. You just double your bet and roll and double your bet and roll. And the only problem is after you double about 3 or 4 times, you need the gross national product of the state of Illinois for margin. And then if you don't have it, you're dead. So Andrew and Mike are spot on.
All right, Mr. Sea Dog, I hope we clear that up for you a little bit or perhaps confused you even more. Either way, it is our want here on this show. Next, we have a more of a comment from user goes by the handle Go Husky. Must be Huskies fan, and he says, I only trade options around earnings. Am I crazy? Well, the short answer is yes. But if you listen to this show for any length of time, you know we've outlined any number of use cases for options, hedging, income generation, that sort of thing, that are useful in a variety of environments. In fact, a lot of us, we've said at the top of the show here, a lot of us here are not huge earnings traders, actually, which, goes against the grain. But I think you find a lot of professionals actually tend to fall into that mold. They know how unpredictable earnings period can be, and even the best laid plans can be thrown into chaos by things like Google vacillating all over the place in the after hours. So in general, I see what the attraction is. The vol is, of course, much higher. There's more potential for underlying movement. It's very attractive, no matter which side of the fence you fall on, dark side, light side, whichever way you like to go. Earnings are very attractive, but as we said many times on the show, maybe you put something on before earnings, take it off going into earnings, all those kind of fun things. Mr. Andrew, what do you have to say here for our friend, Mr. Husky, who apparently only trades around earnings?
Well, the thing is, if you got ADD, that's the exciting time. Am I going to win or am I going to lose? So, ultimately, I think unless everything is sized kind of properly, which means you have to make a lot of small bets around earnings, and you figure some will work, some won't, some will break even. And after commissions, maybe you make a couple of bucks. I've never seen anybody kind of just fully speculate on earnings successfully by just doing it sort of pick and choosing. It's kind of I have seen guys that do it well, that have opinions about the stock, and they basically are using the earnings, the juice in the earnings, to give them what they want for the underlying. So, but they end up with what they want after the earnings. It's either like they're selling pumped up calls against stock, or they'll sell real expensive puts, things like that. So it's a very tough game. It's a binary game. So you got to remember, options weren't invented for binary outcomes in, one day. They are priced for kind of a long-term smooth type of trade. So
unless you're trading on a binary options exchange, in which case that's exactly,
unless you're trading on a binary
what
options
they were
exchange.
what they were designed
yes,
for.
Yes, no.
But this question kind of reminds me of, actually, Andrew, and you probably knew some of these guys too, the guys who would only show up on the floor on expiration Friday, or maybe getting into the tail end of expiration week. That's the only time they would trade, because there was a lot of movement there, and they could usually try to leg into stuff under parity and things like that. It was kind of an old school mindset, but there still were a number of guys who did that. Certainly not that prevalent anymore. I don't think Mr. Husky's outlook on options is very prevalent anymore either, but there still are a few, I'm sure, old school adherents who look that way. Speaking of old school, I won't say you've been around for a while, Mr. Alex. So what's your take here on a guy who only trades options around earnings? Is he indeed crazy, like he asks?
So I'm going to be a contrarian here, and I'm going to tell you that I'm going to recast the question. And I'm not going to say I only trade around earnings. I'm going to say I only trade around volatility events. And is he crazy? Boy, I'm going to be such a contrarian here. No. But he's got to have a real good understanding of how trading spreads against other spreads. There are a handful of hedge funds, two of them here in Chicago, one run by the former biggest market-making firm in this city. And this is all they do. All they do is trade vol events. But they trade them in a very sophisticated fashion. And essentially what they do is I'm going to give a quick explanation, and it's going to be no good, but they try to trade a front-month spread against the back-month spread when the vol in the front-month spread is wrong. And one thing you need to understand is options have volatility, spreads have volatility, and spreads versus spreads have volatility. And what they end up doing is buying a spread versus spread at a phenomenally low vol. So that if it's a 30 vol stock and you can sell a 50 vol in the front month but buy a 30 vol in the second month, you'll end up buying the spread at a 20 vol. Now, it's an oversimplification, but you got to understand concepts like that. If you don't understand that concept, then he is crazy. And he is beyond crazy. He is criminally insane if that's all he does. But if he wants to trade vol events and he really understands vol and how it changes things on a percentage basis, you can put on some very high probability trades with very modest risk. You got to trade size. You got to have small transactions costs. And you have to have really good information. And if you end up doing one of these and a dividend changes between the front month spread and the back month spread, you'll be killed. So it can be done. It takes a lot of technology and a lot of understanding.
Uncle Mike, take us home, sir. Where do you fall on the great earnings or no earnings debate?
If you want to play, I mean, I've had times that I've made money on earnings announcement on hedges, but you need to have an understanding of who you are and what you are as a trader. And like what Alex says, you need to have a focus on it. You need to understand risk management. For me personally, I am not an earnings guy by any means. I like selling premium and watching paint dry all day and then collecting the premium at the end of the month in whatever way, shape, or form. So if you want to play that game, just understand that there's a cost to it and develop a system and make sure that you manage risk above all.
All right. Unfortunately, we have to leave the debate there because it is time for our final segment, Around the Block.
Around the Block.
All right, and welcome to Around the Block. This is, of course, the portion of the show where we tell you what we're watching, and I think you can guess if you've been listening to this show at all, that we're all kind of watching earnings, a final quick rundown here of how things are looking. We've got Amazon still trading about the same levels. Looks like Google has perhaps settled into a little bit of a range now, finally, after all that schizophrenic madness earlier. No, it's back up 30 handles again. Jesus, this thing is crazy today. And that is quite literal vol in action. And then, of course, the other being Chipotle. And they are also hovering up about 47 or so handles. And some other news coming out today in your little stealth name. I was about to tease you about what's coming up down the block. Of course, Zynga. But Zynga looks like they're having their earnings a little early today, up 80 cents in the after hours. What's going on in your favorite name over there, Mr. Andrew?
They're buying a company that has some technology for mobile to ramp up their mobile games. I guess they're paying cash and stock. Doesn't that sound like a cheap price for the company? But I guess they could always sell their headquarters. And they're cutting a bunch of workers. And I guess they're trying to get back to profitability. Their revenues keep shrinking, which I know. Just hopefully they're going to. I'm thinking they're just going to cut their costs faster. And this new game maker, I think, is a way for them to grow revenues because it brings them new that kind of funky mobile technology that they're looking for. So they're basically making the transition Facebook made last year, which is full bore into mobile.
Funky and mobile, 2 words Zynga loves. Anything else you're watching this week, sir?
I'm curious to see how the volatility holds up. The bid has barely come off the panic in the treasury market, panic on the upside. I kind of liked it when, bonds went down and stocks went up. Depending on, but have that. What I would say is that's the old kind of correlation. People jump into stocks because things were good, which means probably higher interest rates down the road, and that would drive bonds down. We had all this funky relationship since the Fed started dinging around in the marketplace. So now, we had a little pullback in treasuries today. I would not call it a reversal or correction by any stretch of the imagination. So the emerging market thing still has people spooked and, I think waiting for the next shoe to drop. So, and again, the market's moving, like Tusa said, I think we have a choppy moving market and could be a good time for investors to buy stocks cheaply or do those 1x2 put spreads to try to acquire stocks about 15% below where they're currently trading.
There you go. Net short units. You like it. I knew you'd come over to the dark side at the end of the day. All right. And Mr. Alex, what are you watching for the rest of this week, sir?
10-year. The 10-year under 270. I don't think anybody would have forecast that, especially in the environment of additional taper. That's the singing clocks in the background. Sorry about that. But looking at the 10-year, obviously watching the markets, watching the VIX. I think the VIX will trade back down to the 13, 14 area. The emerging market stuff, Andrew, I think is spot on. But I think this will all be contained, with the exception of Argentina. But I think there'll come a point where U.S. investors aren't really going to care that much about Argentina. As I say, shocked by the 10-year. But that's what we're looking at. Another thing that's occurred in after hours is there's a report that looks like Microsoft has a new chairman. But they haven't announced who it is yet. So it'll be interesting to see how Microsoft reacts tomorrow.
Yeah, a lot of big news coming down the pike. Mr. Tusaw, take us home. What are you watching for the rest of this week, sir?
Oh, definitely the 10-year, like what Alex said. And I think the other thing that I'm really kind of interested in is seeing how tightly Apple holds to the 500 level. It's a big number. It's a key number. And curious to see if it kind of acts as a magnet, so to speak. The other thing with which I'm looking at is 1,800 on the S&P. For a little bit during this pullback, S&P held the 1,800 mark, but then broke through pretty easily. And just curious to see, I think that'll be a barrier for the market on the way up. And then aside from that, I am picking the Denver Broncos in the Super Bowl. Offense is going to beat defense.
I like it, sir. And all right, that is going to do it for the Around the Block segments. Also, all the time we have here on the old program. But as we are wont to do right before we go, we like to check in with each of our cohorts, my partners in crime here on the old All-Star panel, see what they have cooking in their respective necks of the woods that may interest you. Starting off with you, Mr. Rock Lobster. What is cooking in the land of the pits?
We have an event coming up. Mark is hosting with the Live Vault guys, and I wish I had the date, but I don't. I am totally awful, and you can cuddle it. I don't have anything to add. I'm totally sorry. I was busy all day.
All right, thank you for that, Mr. Andrew. Love the fact that you're still surprised all these years later whenever I toss it to you for that stuff. So thank you for that. Mr. Tusaw, a man who is always prepared for his segment. What is coming up on the old RCM webinar train?
We got a bunch of things coming up in the next couple months. We're going to have a webinar with Mark Sebastian in the coming weeks. We still have not secured a date as of yet. I'll be doing several webinars, but in the meantime, what I want everyone to do is go to rcmwealthadvisors.com/webinars. Check out our schedule. It's updating constantly. We got a lot going on.
All right, and last but certainly not least, Mr. Viceroy, what is cooking in the land of OX education?
A full schedule of webinars, and I'll just showcase one day coming up, Tuesday, February 4th. 3 of the webinars we're doing that day. We're doing a platform and site tour for folks that may be new to OX, and then Jim Wyckoff of the well-known Wyckoff Letter is going to do his monthly futures commentary, and then Nina from our education department will be doing a long puts webinar, but come to optionsexpress.com. You don't need a login. All the education events are free. There are 10, 12, 15 webinars a week. You can see the archive of education. It's all there. It's all free. If you're a new customer, while you're on the site, open a free virtual trading account, and you can paper trade, which is a great way to learn and a great way to start.
Yeah, if you have questions about all the things we're talking about here on the show, like the net short units, and you don't really understand how those things work out in real life, like Alex said, paper trading, great way to try that out. Surf on over to the Options Express website, sign up for a paper trading account, and kick the tires and learn about all these fun things we're talking about and see how they actually play out in the marketplace. I think you're going to be surprised, shocked, and perhaps pleasantly so, hopefully. All right. And on behalf of the Viceroy and the Rock Lobster and Uncle Mike, and of course myself, who has no cool nickname, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, making it such a success. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.